Welcome back. More earnings to take a look at. Looking at Cava, which just hit a couple minutes ago. EPS 22 cents. Revenue 331.8 million. That is ahead of estimates by about $5 million. They do still see fiscal year adjusted EBITDA guidance in this range of they hike it slightly, 152 to 159, up from 150 to 157. So inching both their bottom end and the top end up 2 million. George Tsilis is here though to make some sense of it. George, when you look at these numbers, it doesn't look like the street's overly excited about them. But what do you make of them?
Well, I think the street's not overly excited from the results, which are actually really good. I mean, if you look at the same-store sales numbers for the quarter, 10.8%, they're guiding same-store sales growth between 6 and 8%. So that number is coming down a little bit. That's a function of the number of units in restaurants expanding. So that's not a bad thing. And the sales number higher, beating the estimates by about 5 million, 28% higher, 61% higher on adjusted EPS, 22 cents versus 13 cents. Now, the reason it's trading to the downside, and I can see why, is it comes down to just valuation. If you just consider, prior to today's report, the estimates for this full fiscal year were 55 cents. So I'm sure that's going to be adjusted higher slightly because of this quarter for the next at least 3 quarters going into the end of the year. But, prior to today's release and numbers, the stock was trading on 180 times this year's earnings. So that is, I think, the problem right here for Cava, which has been growing its store footprint. As of the end of last year, there was 327 stores. Just going back to 2016, they effectively had about 26 stores. So they've been growing their store count by no more than 10x in the last 9 years, expecting 1,000 stores by 2032. So this is really a phenomenal growth story. It's a profitable company. By the way, they denoted EBITDA margins of 25%. I looked at the last 4-quarter net income margin around 13%. That's pretty comparable to Chipotle, which is a much larger volumetric restaurant operator than Cava. So it is a profitable business, but I just think that right now the valuation is holding it back, and that's why we're seeing a little bit of a drift to the downside. So essentially, if earnings increase, estimates increase for the full fiscal year, and price comes down, that should compress that earnings multiple down from that 180 for this year and 140 for next fiscal year. But still, I think that's quite rich, even considering the EBITDA growth estimates prior to today's afternoon release of the numbers of around 40%.
Yeah, George, good call out. Obviously stronger, but just subtly stronger comp sales growth. And then also trying to fight back a little bit here in the after hours. I do see an interesting Wall Street Journal article as well, which is that the company's been stockpiling equipment, trying to front run some of these anticipated price increases due to tariffs over the last year or so, knowing that they were going to continue expanding. So a forward-thinking management group. I'm sure the conference call is going to have an impact on ultimately where this stock opens up tomorrow. But I also love the call out, too, of this 6 to 8% forward guidance for comp sales. It's basically what the street was looking for. So, yeah, it's decelerating, but the street was already kind of clued into that. George, I wish we had more time. Excellent insight, as always.
Okay, Alex.
Thanks so much, you, for joining us, and we'll look forward to discussing more soon.